With this video in this playlist, we will start learning the concepts of this subject, technical analysis, and we have to start with the Dow theory. Dow theory brings in the foundation to the subject. Now, as we progress, maybe after a year of knowing the subject, you may not implement Dow theory as it is, but knowing it is important. It's like knowing ABC is important to frame the sentences, the paragraphs, and the storytelling. So let's start with the very first concept of technical analysis, the Dow theory, and in this video, we will cover the three main tenets of this theory. So Dow theory is, as you guessed, is named after Charles Dow, and the father of technical analysis. And earlier in one of the videos, I think I had mentioned that he was the founder editor of the Wall Street Journal over 100 years back. And every fortnight he used to share his observations of the New York Stock Exchange and the various stocks that used to get traded. Now, as far as I have read and I know, that Charles Dow never actually came out with his own theory that, hey, listen, this is my theory, the Dow theory. It was his students, his followers who later kind of combined and collated all his writings in those Wall Street journals, and they came out with the Dow theory. By the way, to know more about Dow theory, I think you should read a book written by Robert Rhea, R-H-E-A, and the name of the book is Dow Theory. You will find it fascinating in detail work about Dow theory. Charles Dow's observation, which he wrote down, which he presented in his periodicals, can be kind of broken down into 6 main tenets. In this video, I'm going to cover the first 3 tenets with you. What is the first tenet? And to talk about the first tenet, I will take you to my notepad, and we're going to talk about the Dow theory's first tenet, tenet number 1. Now, the remaining tenets are relatively easier to comprehend and understand. This one is not difficult, it's a little vague. Let me phrase it first. It says that markets discount everything, and it stops there. I'm going to add an extra line to that. Market discounts everything, and comma, I'm going to add an extra bit, and I'm going to say that except the act of God. Now, what does this mean? What does this line means? That the market accepts everything, and I have added a little bit of extra, except the acts of God. Let's break it down. Let's talk about the first part. Market discounts everything. This part. This is the first tenet of Dow theory. What does it really mean? What it tries to tell us is markets already know what's going on, and it has already taken into account what's coming up in the future. In other words, I can say that I can write few words like, say, smart, and I can say something like forward-looking. Not only just forward-looking, but it acts upon it in the present. Let me give you a couple of examples which will help you to understand this better. By the way, when I first read this in late 2024, I didn't understand anything. It was much later when I really experienced it that I know that, oh, now I understood what Charles Dow meant in his first tenet. Let's give it a very simple example. Let's say in your country, you find that a car maker has launched a new car. It looks amazing and it's all booked out. You are not going to get a car in the next 1 year's booking. It's such a hot cake, it's selling. Now, if you are smart and if you are forward looking, then wouldn't it strike you that this car maker's numbers, revenue, earnings will definitely increase the next few quarters? Don't you think so? Because it's selling right now, it's pre-booked, everything is pre-booked. And if that's the case, and if the company's overall performance, profit and loss is going to improve, revenues will improve, then the stock price should reflect that. So tell me, will you wait for this company to come out with their quarterly results after 3 months, 6 months, 9 months, and they will come and say, oh, listen, our new launched car has sold wonderful and we have made a lot of profits, and this is a very good news for us. And then the market will decide, oh, such a good news have come, now let's buy the stock, and the stock will go. Do you think this is the way it works? This is the way the world works? No, right? What you will do is, if you are both smart and forward looking, then you will discount it in the fact that you will start buying the shares of that four-wheeler company, that automaker, today, because you have figured out by the data that this should reflect to better earnings, and which means that the share price should go up. Let's buy it now and not then. And like this, there can be n number of examples wherein someone like we or the market participants are taking a position now, not based on the parameters of the now, not of the present parameters, but of the future, looking forward looking, based on that taking a call. Now, insurance, you can take the example of what happened during the pandemic, or any kind of such a pandemic. If it ever happens, then you would know that, these are the pharmaceutical companies, the healthcare companies are the immediate beneficiaries, and their revenues will soar. And so you saw what happened during the COVID-19 period. The pharmaceutical and the healthcare pack just went off the roof. So this is what he meant, that the markets are smart, market discounts everything. I added an extra bit by saying, except the acts of God, means if there's some kind of a natural calamity which might impact a certain area, which might again impact a certain company or its factory, etc., that the market probably doesn't know at this juncture. So if there's some kind of a tsunami or an earthquake or anything which is not man-made, the markets probably will not be able to discount it. This is the theoretical part. I did tell you that in my experience, when I read it 20 years back, I seriously did not understand, and no one was there in YouTube to make it this simple for me to understand. But then when I started my career in mid-June 2005, later on, I still remember that the CNX IT index and most of the IT stocks were doing wonderfully well. And then the quarterly results were coming up, and their earnings and revenues, all those things were very, very positive. And then they did not actually go up. They plateaued out and they started coming down. And then I realized, okay, the markets already knew that the results are going to be really good, and that's how they discount. And like this, there are many, many such examples. Now, does the market discount left, right, center, everything? Not really. There are instances when it's all of a sudden like a black swan event and all those. The markets will not be able to discount it completely. But in general terms, market knows, market is smart. Now, I will add an extra bit to this tenet with you. This discussion, this explanation that I did was a theoretical explanation. If I say from here, what is the practical side to it? What is the practical side to it? Okay, question mark. What is the practical angle to this? Then I would say, as a student of this subject, as you exercise technical analysis, whenever you see a stock price, a chart going up, okay, you need not, please understand, you need not ask that why is it going up. You need not know why is it going up. It's not necessary to know why the market is doing what it is doing. Because what the market is doing in the now, in the present, is very, very likely to do what's coming up tomorrow or later on in the future. So when you're analyzing a chart, when you're trying to understand the market, you can keep that knowing thing aside and focus on the price itself, because what the price does is the ultimate. That's tenet number 1. Tenet number 2 is about 3 different time frames, 3 different time frames that the market moves in. I would say 3 different time frames. What Charles Dow is trying to tell us with this tenet is there's always a long-term primary trend, the big bull market or the bear market. And within those primary trends, there'll always be intermediate trends. Intermediate, that's the medium term. And within those intermediate, there will be short-term fluctuations, which are the minor trends. So you can call them minor trends or short term in nature. These are your intermediate or medium term trends. And then the mega trend, the mega cycle, the major cycle, which is the primary or the long term trend. To put this into a little bit of more practical application point of view, whenever you open a chart, what I would suggest is you should keep an eye on 3 different time frames, right? And I'm not going to go about choosing any particular time frame. What I would like to say is, from a general point of view, you should know what is the main monthly chart, what is the behavior of the weekly chart, and how is the daily chart playing out. And you can consider them to be your short term, your medium term, and your long term. So whatever trend the monthly chart is telling you, you can consider it to be the primary trend. That's the monthly chart. Whatever the weekly chart is telling you, you can consider it to be the medium term or the intermediate. And then the daily chart you can consider as the short term trend of that particular chart. So you should not just stop at the daily chart and analyze, oh, this is what the analysis is. You should keep an eye on weekly and the monthly. Markets tend to behave in 3 different time frames. Now, with 3 different time frames, moving on to the third tenet of Dow theory is 3 different phases. Now, this is an interesting one, which Charles Dow definitely figured out while he was, writing all those periodicals in the Wall Street Journal. Now, this is where I have to draw and explain it to you is, let's say the market or any chart is in a downtrend. When will it be in a downtrend? When supply will be greater than demand and the market participants are willing to sell it at a cheaper price. Now, after it falls for a significant percentage, it may stop falling and it may not also go up. It might create a kind of a range for itself. A range bound price behavior. This may be, or this what Charles Dow's third tenet is trying to tell us, is an accumulation. Generally, volumes tend to be spiky at times, means all of a sudden when it was falling, you'll see large volumes, not consistently huge volumes, relatively more volumes. What are volumes? We'll cover this in a separate video later in this playlist. But remember that volumes are the number of shares exchanged hands, the degree of participation on that particular day or week. Now, this is where after the stock has got relatively cheaper, it's relatively much at a discounted rate, institutions or large funds are accumulating it. And they don't want to accumulate it at a go because they would buy a lot of quantity and their own buying will push the price up. They don't want to do that. They want to slice their quantity in multiple smaller parts and in little bit of smaller pieces they are accumulating it. Once the accumulation is over, things turn around and what was earlier not a good chart, it was a downtrend, picks up and gives a fresh breakout. Now the situation, the scenario has kind of become opposite, wherein the demand is now greater than the supply. It's in an uptrend. Now, you'll notice if you want to go a long distance, at times you'll take a break. If you've gone on any kind of a road trip anywhere, you'll generally take a short, small break and then you move forward again. Charts also behave like this. At times, after a big move, charts can take a small break. These small breaks are essentially called consolidation. It consolidates, it takes a breather. One good thing about consolidations, remember, very low volumes. It comes with very low volumes. Remember that. But listen, this chart wants to go further up, right? The trajectory is further up and then it will tend to trend further upside. Then it might get relatively much more expensive than where it was, let's say a few months back or a year back. And then similarly, it can try to create another range bound price behavior. This, the third one, which looks like a consolidation, can become a distribution. You should be guessing by now that distribution is when those who bought at a lower level here are enjoying this profits up here they would like to come out of it or at least partially sell it off. Again, another thing that you should keep in mind, distributions volumes might be at times spiky on the upside, means you will see bursts of high volumes once in a while. And then this chart actually comes down. So remember, before an accumulation, it has to come after a downtrend. Distribution comes after an uptrend. Distribution comes after an uptrend. Accumulation comes after a downtrend. Consolidation comes midway of an uptrend or midway of a downtrend. And the key thing to remember in consolidations are they come with very low volumes. Volumes are pathetically very, very low. Now, this is the concept. When you take a look at a charts, it may not play out exactly this way. You should try and check more of cash market charts and not necessarily futures and option charts. Don't do that. At the initial stage, try to analyze more pure cash market stocks and charts which are not in the derivatives segment. They will fit these kind of behavior and criteria more. But there's more to come to the Dow theory. There's tenet number 4, 5 and 6 which I'll cover with you in the next video. Till then, I hope this video clears out the initial few pointers of Dow theory. Take care and trade well.